Hello, everyone. Welcome to this year's final instalment of the Revive Roundtable Webinar series. I'm Jarvis Archer, Head of Business Restructuring and Insolvency at Revive Financial. Today, we're tackling a difficult challenge that's becoming increasingly common, and that is assisting a business when its revenue or profit are flat or declining. And it can be hard to know where to start with these businesses, just problems everywhere. Business owners can feel helpless and they often do nothing. And hopefully they turn to you as their accountant, bookkeeper, or business advisor. But one thing's for sure, they'll definitely blame you for their problems. So that's all good. But as their accountant or bookkeeper, dealing with their financial performance may not be something that you're engaged to do. It may not be a service you offer, or the client's position might be so critical that you don't feel comfortable dealing with it. You might have insolvency concerns. So today we aim to help you better become more confident dealing with these situations so that you can better help your clients and you know who to turn to if you want further expertise. So I'll just introduce my co-host today, Jacob Aldridge. Some of you may know him. Jacob has been a Guinness World Record holder in 2003. He was Time Magazine's Person of the Year in 2006 and Zero Partner of the Year in 2017. So it's quite a bio. I only feel slightly inferior. His background is that he's an international business coach and advisor. Over the last 18 years, he's worked at depth with more than 350 companies in 14 countries. And he was in Australia during the GFC and the COVID recession, and then in the UK during the Great Recession, which is apparently the recession that came after the GFC. So new learn for me. Jacob is smart, apparently sometimes funny, and when it comes to the emotional challenges of emotional challenges and commercial opportunities of growing small businesses, and Jacob is both experienced and knowledgeable. So welcome, Jacob. Great to have you here.
Thanks, Jarvis, for that impromptu bio. You nailed. No, it's good to be here, and absolutely, it's a good time of year. I think a lot of us are feeling a bit exhausted, and we're feeling a bit drained from our clients, and also starting to look ahead as to what we can do differently and help them do differently in the new year. So some good conversations to be had over the next hour.
Excellent. So a general disclaimer there. The info, naturally, it's general. It's not professional advice. If you want professional advice, contact us or a suitably qualified professional for tailored advice. So the aims for the session today are to help identify those clients whose businesses could be doing better, become more confident in dealing with the clients that are flatlining or in decline, change that mindset a little bit that problems don't need to feel like problems. There's actually opportunity there. Have some ideas of what we do and why you might turn to us for particular types of help. Give you some tips there around having that broader conversation with clients who are struggling. Often it can feel like you might lose the client if you have the conversation, but what I see is most people refer to me by a new accountant, so they've changed accountants because they didn't have the conversation. And then understand how the economic cycle can impact your clients. But we're not economists, so we won't go too deep into that. So look, feel free to ask questions through the session. Use the Q&A button so it doesn't get lost in the chat, and we'll either answer along the way or at the end. So look, quick poll to get us started. And that is, look, how are your business clients doing? So naturally, I'm skewed because everyone that talks to me is having trouble. Jacob's got a mixed bag, but it's good to hear.
Most of my clients are doing extraordinarily well, but not necessarily right. when I first met them.
So yeah, you and I are on the tails, but what's happening in the middle? So I'll just give everyone a little moment to get their answers in there. Okay. A couple more responses coming through. All right. Well, look, I think that looks like we've got all the answers in. So I'll launch that poll. Sorry, in the poll and share those results. So no one said all their clients are making money. So I guess that's good. We're not completely irrelevant. 36% doing okay, but things have tightened. Mostly good, but a few struggling. 43% felt like they're there, and then a lot seem to be doing it tough, 21%. So I guess what that means is there's an opportunity there if you're not already speaking to those clients to start the discussions that we're going to talk about today. Okay, so I'm going to rip right in. So the financial swamp, that's really what it feels like to a lot of people. Revenue's lower, it's going down, costs are going up, margins are squeezed, they're going into the negatives, or if they're already negative, they're going more negative. And where that loss making shows up is on the balance sheet as debts to the ATO or debts from the direct loans from the directors where they've refinanced the house to prop up the business, or they've got short-term lending on there, Prosperous Maulers, Get Capital, those things, which are all a natural reach, but not necessarily the solution. And so what's happening now, that was all well and good. A bit of that was happening through 21, 22. But what's happened in the last 12 to 18 months is the ATO said, well, actually, we want to get paid now. Our debt's doubled from 25 billion to 50 billion. And what's interesting is that despite all the notices they've been issuing over the last year and all their efforts, the debt book doesn't seem to actually be coming down. It's persistently staying up. So what that means is that, sure, they're collecting some out and writing some off, but it's also the new stuff isn't getting paid. So naturally they're squeezing tighter and tighter because the political pressure is on them to bring that headline number down. And then the Australian Small Business and Family Enterprise Organisation released a Small Business Matters report in June. And from their findings, 43% of small businesses fail to make a profit and 75% take home less than the average wage. So there's 2.5 million small businesses. The view out there is, business owners, they've got so much money, but actually, I think they've really been the ones, particularly small business owners, that through the last few years have had the most squeeze and being the least looked after. So important to look after them. So look, they're in this situation. What do we do? They don't know what to do, just kind of going round and round, stressed. So you get people that do nothing. Some people say, they're burying their head in the sand. I tend to feel like it's more paralysis there around not knowing what to do, but ultimately they do nothing about it. They might go obtain finance, so get that online loan, a quick hit of cash, seems great at the time, and then the cash is gone, but the repayments there and the 40% interest rate actually cause more cash flow problems down the line. What I'm talking to a lot of people about is reducing the debt, particularly the ATO debt. And so the small business restructures, the main thing there, aim to reduce the ATO debt in particular and any other debts that are included by approximately 80%. And with the costs on it, really the easy way to present that to people is I say, look, you're really paying 1% of your debt a month for 24 months. That's what it works out to be, with the cost about 24% of their debt they need to pay. So if you've got a 300 grand debt, it's easy to someone to say, well, can you afford $3,000 a month for 2 years? And you get to write the rest off. It sounds pretty good, and that's why it's become popular. Voluntary administration and deed of company arrangement, been around for a long time. And then a sale of business there to a related company is another option that people do. That's really phoenixing. And it's interestingly enough, the people that they used to send me liquidations where they do the legal phoenix, they now send me the small business restructures because it's a better option. So the last one is closing the door, liquidating. And there's nothing to be ashamed of in calling it quits. If you're just not into it, as a business owner, you're done, or you just can't see that you're going to dig yourself out of the hole. It's better to draw a line in the sand than to keep trading cause more losses to everyone, including yourself, cause potential bankruptcy and loss of your house, better to see the writing on the wall early. So having the discussions means less damage is done. So while these are all good options to solve a problem, an ATO debt isn't the cause of a problem, it's the symptom. And so all these options are assuming that the business is viable, it's worth putting more money in, but really they need to be at least break even, and hopefully they're making sufficient profit, which means hopefully they're making enough profit that it gives them a wage. And I know all the accountants and bookkeepers have creative ways of taking that out, and however you do your director loans and your distributions and whatever you do, that's up to you. But as long as they're earning enough and that doesn't end up with the ATO debt being about the same as what they take, which I often see. So cash flow relief is essential, but it's more of a crisis causer, and it doesn't fix profit. It's like cash flow causes a crisis, but the profit is the purpose for the future. So that's all well and good. Let's just make the numbers better. But the problem is for business owners is, and particularly a lot of them the last few years, they've never experienced financial difficulty before. It's just the business has always run well enough and they've had enough money to pay for their lifestyle as well as their debt. So a lot of them don't know how. The business has changed and in kind of complicated ways where it might have gone online or employees expect different things. They just don't understand the numbers at all. That's very common. People often don't know whether or not they want to keep trading or not. Everyone wants to keep trading, but when you scratch below the surface, sometimes you find out that actually they just call it quits. I spoke to someone a couple of weeks ago who said, no, I want to save the business and save my house and get out of the personal guarantee for the lease. And then I saw that they went with liquidation last week, and I called them yesterday, and it was because their wife they were in emergency in ER, and their wife had sort of had a suspected heart attack because the stress of trying to run the business was too much. And so they just shut it down. And so, nothing's worth that level of cost, not a business. The business is supposed to make money for you. So pricing is a big mental hurdle that I see for people, just not raising them. I've been a lot of mental health challenges as well as physical health challenges, and people have been uncertain how to solve complex challenges on their own, and they just don't know who to turn to. So some people don't know that their accountant's the person to turn to, and others think, oh, my accountant will tell me if there's a problem, but they haven't said anything, so there mustn't be a problem. They don't look at their numbers. They just listen to how much they've got to pay to the ATO. So all opportunity. So look, I've just got an example profit and loss here. Some of the, one of the things I'm talking about. So this business, it's a restaurant in Melbourne. So naturally it had a tough time there. It looks like it went okay in 2021, but lost 200 grand in 22, another 123. And then year to date, sort of 50 grand of losses. This guy definitely doesn't want to close his business. He's doing an SBR, small business restructuring, to get his ATO debt down. He certainly has some prosper loans, but thankfully he still has the cash. And so, there's despite looking at this and going, well, it doesn't look like a great business over its life. It's lost a few $100 grand. When's it going to start making enough? Business owners don't have that mentality. They've got the passion, they've got the ideas, but someone at some point should have been having a tough discussion with this guy to say, hey, we need to try and make changes now, because although you've been going from 450 grand in sales up to 1.6 in a few years, that's great, but we're actually losing more money the more sales we do. So at what point do you become profitable? I mean, unless it's the next Uber, not sure. So look, I'll just run another poll here, and this is around the causes of struggle. So what are the causes of struggle that you're seeing your business owners dealing with? Now, sorry, I just need to relaunch the poll, actually, sorry. Okay, I've done the wrong thing, I think, sorry. Okay, here we go. All right, so hopefully that poll is showing up there. So yeah, what are the causes that you're seeing? Certainly, yeah, some interesting things that we're seeing. Someone that's got 400 grand of BAS debt, purchasing a RAM to save tax. Lo and behold, that hasn't eased his problems. And he wasn't making profit as well. His profit and loss looked like the one that I just showed, where it was making losses. Okay, I think we've got all the results in there. So I'll just share those results. So economic forces, 30% of people said that. So I think it was a multi-choice. So we got lots of options. COVID related. So it's interesting that, they're only a quarter to a third of the responses people are given, but lack of business management skills also low. Directors' excessive spending, 70%. So that's not uncommon. Certainly see that a lot. I guess, it's excessive compared to the profit that they make. I guess that's the key. If their business was making more profit, they'd be able to afford the lifestyle they think they deserve. Ignoring ATO debt, 60%. The team not performing, sort of lower portion. Lack of good financial controls. Well, they've all got excellent accountants and bookkeepers, so that's obviously not key. Lack of demand for the business offering. So that's only one response has been that. So that's interesting. It's not the demand that we think is the problem generally. So mental health, 30%, inability to access capital. So that sort of falls into those people looking for finance. They haven't raised their prices, 30%, excessive costs, and then owner not acting. So sort of even there across a lot of them, but ignoring ATO debt and directors excessively spending are probably the two key ones, as well as some mental health issues. So I'll keep moving. Now I'll hand over to Jacob. So I think you got control there.
I do, thank you. I joked that all of my clients are doing extraordinarily well. That's definitely a joke. I think I've had more new client inquiry the last 3 months than I have the last 3 years since COVID really kicked in. And I think that speaks to exactly what you're talking about there, Jarvis, and a lot of those answers that came up on both of those poll questions, that there's a lot more business owners now who are uncertain, they're feeling squeezed, things that used to work aren't working anymore, and they're looking ahead, and a lot of doom and gloom around in industry publications and the wider media. And so they're trying to work out, exactly what they need to do differently. Some of them go and talk to their accountants as the trusted advisors. Some of them bypass that entirely, which is a mistake, and go looking for the magic bullet somewhere else. Some of those people find me, and they turn out mostly okay. I wanted to really start, before I jump into a couple of the slides that I've prepared that go over a lot of those questions that got, the options that got answered just in that poll. Start by quoting Banjo Patterson, Australia's greatest bush poet and also an accountant. And he wrote in Banjo, in Clancy the Overflow, he wrote about the round eternal of the cash book and the journal, which goes to show you can be a creative accountant and still fly within the ATO legislation. But he recognized that the cycles of business and the frustration that shows for a lot of finance professionals, accountants, bookkeepers. My take on a lot of modern business training podcasts is that it tends to focus small business owners way too much on the linear. What's the 5-year plan? Where are you going to be in 20 years? What's your vision, your purpose? It's sort of, you have to be growing or you're dying, which means that many business owners don't realize there is a real cycle and rhythm to their business. And I'm sure most of the advisors, accountants that are with us today would recognize things like clients that 2 months out of every 3, they think business is going fantastic and they're flush with cash, and then they get the quarterly BAS payment, or back when they had quarterly super bills, suddenly that all this cash goes out and they think, why did my business suddenly go in the toilet? It's just the quarterly cycle. Some businesses do have an annual cycle. I work with a pest management company. Summer, spring, summer, they're run off their feet, absolutely busy. Every winter, it's much quieter. That's not a business failing. That's just the natural cycle of the work that they do. And there's a lot of these cycles that impact business owners that they don't have awareness of. One of the big ones that I wanted to touch on, because it's less, well known and applied by accountants and advisors, is the economic cycle. And as Jarvis said, we're not economists, the dismal science. I've been doing a lot of work since the GFC, a lot of extra training and work with clients around the economic cycle and understanding the impact of that, as well as all of these other cycles. But it's something that I'm getting more and more questions about. So I wanted to touch on it a little bit and help prepare you to help your clients prepare for what is potentially coming next year. And most of us have got some understanding of the economic cycle, ups and downs, booms and busts. And it's important we recognize that there's an emotional aspect to that. When things are going well, everybody feels amazing, 10 foot tall and bulletproof. When things are at their worst, everybody feels terrible. And the old saying is, buy when there's blood on the streets. I, based up here in Queensland, always like to say, when the front page of the Courier Mail says to buy, that's time to sell. And when it says sell, that's time to buy. There's often a bit of advantage of being counter-cyclical, but you've got to be able to hold your nerve, and you've got to understand that these are cycles that come. And the COVID recession, even though we technically had one, was really strange and unusual by historic standards because of the amount of stimulus that went in to try and get us out of it. And that's starting to come home to roost, both in inflation, which is squeezing margins for many of our clients, but also for the fact that we had a downturn and then things were absolutely unbelievably good for so many businesses because of JobKeeper and some of the, the little loopholes or the short-sightedness that came with the speed of that, that there's a lot of zombie businesses around that don't even realize that they actually died in 2019 or 2020 and they're still walking around and they're going to face the music. And that may not be your clients, but it might be their suppliers, it might be their clients. So it's important to understand that we're certainly not on an upswing from the cycle. These cycles are ups and downs. It's just something that we go through every 7 to 10 years, not necessarily a recession, but upswings and downturns. And businesses face that in one of 3 different ways. Mike Tyson famously said, everybody has a plan until they get punched in the face. Everybody's got a plan until their 3 best clients go into liquidation because of something that was unforeseen to them. Or they are those zombie businesses that have been going on for year after year after year, making a loss, somehow staying open, surviving, and then something finally tips them out, which could be an economic downturn that shuts their customers, could be other things, but they dive. So the first thing that some businesses do in a downturn is they dive. They just take that punch, fall to the floor, and never get up again. Now, doesn't mean the business owner isn't a beautiful, wonderful human being who has the opportunity to do their next thing, but that can be the end of that business as they know it. Most businesses survive. They go down when the economy is down and they come up when the economy is up. The end of the cycle, they're in much the same place that they were before, thanks to inflation. They've managed to keep their prices and their costs in line with inflation. They feel like they're doing better because the numbers are slightly higher, but adjusted for inflation, they're really just going up and down, bouncing along the current, not making too much of a difference. And then there's the third type of small business, which are the ones that thrive, the ones that can respond to the opportunities at any point in the economic cycle. And more market share, more opportunities are created in a downturn than at any other point in the economic cycle. And that's the opportunity for us as advisors. When we're giving good support to our clients during difficult times, that's where we build loyalty. That's where we build strong referrals to other quality clients. That's where we can really make a difference. And that's where we can learn in our business how we need to change and respond. Because the way we did business in 2019, the way our clients were doing business in 2019, isn't the same way they're going to be doing business in 2024, 2025. The ones that can learn from that change and evolve are the ones that thrive. The ones that don't learn and just keep trying to do what they've always done are those ones that survive or risk diving. So when you think about your clients, when you think about what they're going through, this is a very simple, useful little thing to ask yourself. Are they running the risk of diving? Are they just going to survive? Is there an opportunity for me to ask some questions about what they're going to do differently that could help them thrive? And then that obviously has flow-on effects to your business. And this is a case study of mine from the great recessions, they call it in a lot of the world, the GFC as we had here. This was when I was working as business coach, small business advisor in the UK. And this is one of my favorite business models. I've had about 4 or 5 different clients who've had this business model, which is this fractionalized professional service. A lot of people who come out of big corporate roles in marketing, finance, or strategy, they want to do their own thing, do a bit of consulting, but they want the camaraderie, and frankly, they have absolutely no idea how to run their own individual business. And so they group up in these fractionalized models where they can go and get a handful of clients. The client benefits from their expertise, paying 1 day a week, 1 day a month, whatever it might be. And this person gets to give back as the expert without having to run the whole business. It can be a really beautiful business model. And for this client, that was an example. They started in 2003. By 2007, just before the financial crisis, they had managed to grow to £3 million. This is 15 years ago now, so that was not too bad for a small business in a few years. They actually saw something like 2/3 of their clients drop off in a 6-week period. You can put all the contracts you want in when a recession hits and when a whole lot of clients start to dive or just face survival. No good business advisor is going to try and really push those contracts. So they got smashed at the start of that. And by the time I met them, they were back down to £2 million, and they'd been bouncing along there for a few years. What do you think they did? If that was your client, they'd gone from 3 million fast growth suddenly back down to £2 million revenue. What kind of conversations would you have? What are some ideas that you might suggest? And this is where I find a lot of accountants that I work with struggle with the business advisory piece, because it's a slightly different mindset to so many of the accounting conversations. With accounting conversations, there's accuracy, there's precision. You're good at being correct. You're good at being able to interpret information. When the proverbial hits the fan, there's a lot of uncertainty, volatility, ambiguity, and it can feel very uncomfortable for someone who's great at being certain around the numbers to open the door and have some of these uncertain, ambiguous conversations. I think most accountants have the skills, they just don't always ask those questions. And the business model for many accountants makes it difficult as well, with the limited time you've got to open those doors. This was a business full of smart people. They did a lot of the things that you would expect. They slashed costs, moved to a smaller office, they cut their prices and their packaging so that it was cheaper to engage with them. They went and recruited. Beauty of this business model is that you're recruiting experts. A lot of people lost their jobs during the recession, and so they were looking for this kind of opportunity and role, and being structured in this licensed or franchise model way, you didn't have to pay them a salary, so you recruit, you tap into their networks. There's a lot of things there that ought to have created growth, and yet it didn't. And so they pulled a lot of the financial levers and not had any change, been stuck at that £2 million turnover. So I went in, did a business review, and what I found was a group of really smart people, and it was like trying to herd cats, because they all had an idea of what they thought the business ought to be doing, and in many ways they were just doing their idea and not really coming together. Communication had fallen away. This is one of the most common things when businesses go through difficulties, is the business owner will communicate less. They don't want to go out to the team and give them any bad news, so they resort to silence. And most people don't hire idiots. Your team know when things are stressful. The team know when the business owners are huddling in and closing the door, or they're on the phone and offered at the accountant meeting more often, some of these kind of things. And the team will project into silence their worst fears. And I remember, particularly during the GFC, which was the first recession that I had worked through, seeing a lot of business owners where their best people were quitting to go somewhere else because of that silence, because of that lack of communication. Whereas even being honest about the situation and what the business owner was doing to address it and get through it would have helped keep those good people. It's the good people you lose in a downturn, because they're the ones who can actually find another job. You end up with the worst of your performers hanging around and not performing. So I implemented a whole lot of extra communication channels, regional leader group meetings. I actually recommended that they take a higher percentage. So essentially all of the experts were paying more of their revenue each month into the central to invest in marketing. built a website. They got to number one on Google and a few key things. They started implementing a newsletter, so communicating out with the clients. And I helped them redesign their induction training program. In fact, all of the people who have been through the old program came back through the new program, which was an expense to the business. Now, overall, this was about 5% of their revenue. So, £2 million. So it was about £100,000 that they invested, not all in me, in implementing all of these projects, websites, newsletters, and the induction program. But we made that more practical. We changed how they trained their team. We changed how their team sold, and we changed how they communicated with their clients, because the recession had changed all of those things. When a recession comes, when an economic downturn comes, people think differently about how they spend. They think differently about where they put their money. And if your business and your business clients aren't also changing to respond to that, then they get caught up in the old way, and that's where they bounce up and down. We changed their business model a little bit. We changed their priorities around what they were focused on as a business. And within 18 months, we'd actually got them to record new highs. They were doing £4 million a year in turnover. So even though they were going through a double dip recession in the UK at that point in time, this business managed to get to all-time growth revenue highs off the back of taking on some of this advice and mostly communicating more internally and externally. So what separates those three categories? The business owners that dive, the ones that survive, and the ones that thrive. For me, it's a combination of these two. One is internal and one is their external investment activity. So the business owners that dive, the ones that get punched in the face and don't get back up again, they tend to ignore their emotions. They try and push them down, suppress them. They pretend the F word, feelings, doesn't apply to them. Suppress your feelings doesn't get rid of them. What you resist persists. They don't go away. They certainly don't go away for the team. And the business owners are communicating then through their feelings instead of talking about them. And they stop investing. They just freak out, stop spending money. And investing in business doesn't necessarily mean huge speculative things. This is, we stop recruiting. We stop doing pay rises. We stop doing marketing. We stop investing because we're so panicky and worried. You stop investing, you stop getting a return on investment, and you need to be changing your business because of the economic cycle. That's a risk. The business owners that survive are the ones that they bounce up and down. So they react to their emotions. They have a great day, they're fantastic. They have a terrible day, they're terrible to work with. They come and have a meeting with you, their advisor, their accountant. They're feeling fantastic. The numbers look terrible. They go back to the office and they have that absolutely shocking week. Things get worse. They wait to invest. They wait until they're confident that everything's picking back up again. So they don't invest until the bottom of the cycle. It takes on average 18 months for a good business investment to pay off, which means that they're missing the first 18 months of the upswing by waiting until things are confident. That's why they stay stuck to the economic cycle instead of growing. Whereas those business owners that thrive even in a downturn are the ones that recognize that we are all human, that when things happen, we will feel them. We acknowledge those feelings. We don't get attached to them. We let them go. We talk about them. We share them. And they continue to make strategic, ongoing investments. This is where, if I completely generalize for accountants, can create real problems, because a profit and loss statement doesn't clearly separate out for an advisor or a bookkeeper or the business owner trying to understand it, the difference between an investment expense and a regular ongoing cost to the business. Obviously, if it's capital and it sits on the balance sheet, that's different. But a business owner that decides to invest in marketing, invest in more staff, that still shows up as a cost. And so if they've then got an accountant that they're only seeing infrequently, once a year, maybe for tax planning or some of those things, the accountant isn't in their business, isn't able to give them a whole lot of the support, says you need to cut costs, because they can't see in standard financial reports the difference between investing in strategic growth and carrying too many costs, spending money that they shouldn't be. And having that conversation with the business owner, do they know the difference, is incredibly valuable when things happen. This is another simple tool that I wanted to share to help any advisors here with the conversations that they're having. Your business owners are struggling for any of these reasons, whether that's some of the economic cycle information or the other reasons that we've outlined. It's useful sometimes to think about the different ways that that can show up. We will see it in box one, the stuff, the business content, the profit is disappearing, they're a little bit stressed, team members are leaving, whatever it might be that we can see. And we can hone in on that, but it pays to understand and to help our clients understand the context that sits around that content. Why? So box two is the business context. So you might have a situation where the business is losing money, it's bleeding money, the cash flow is absolutely awful, and you know that's a problem. You've got to understand why. Is it because they've got one of these 40% loans, and then maybe there's something you can do about it? Is it because they've gone out and bought a RAM? In which case there's that conversation. And that then starts to get us into box three, which is the personal why. The business owners that just treat their business accounts like it's a personal piggy bank. They're pulling money out. They've got the shoe addiction, the gambling addiction. They want the flashy new car, whatever it might be. And you can't fix the business content if you don't understand some of that business and personal context. If they have a gambling addiction, to pick a really extreme, simple analogy, trying to help them understand cash flow cycles is not going to solve the problem. For most business owners who hit the financial swamp, it's less around something as obvious as a gambling problem and more around just the habits they've built, particularly during good times, during growth. Many business owners didn't realize how freakishly good the COVID stimulus packages were. They thought that that was going to last forever, and they built their life around that lasting forever. Your ability to have that conversation with them, that if the economy is changing, business is changing, if things are tightening up, they need to change personally, they need to change their business why and purpose and focus, and then improve the business content. That will make a decision. So how do you see, if you're looking at the business content, how do you see that there might be some issues in those boxes? It's not just the numbers, often it is the numbers. Again, one of the challenges for many accountants is that you don't get a chance to be monitoring your clients. It's where that real value of the financial advisory or the strategic advisory services can come in. The more visibility, the more frequently you can be looking at your clients' financials and talking to them about it, the sooner you're going to spot some of these problems. Even if you don't know why those problems are there, you're going to be able to see them. You have the ability to feel off a profit and loss statement that things aren't working. Again, if you can tap into your feelings. But often it's not the financials that you'll see. It's the client that used to be really responsive that is now less so. It's the clients that are avoiding the conversations you know that they want to have. And a simple case study is a new client that I started working with earlier this year, where the CFO called me, said, good business, profitable business. They've made some strategic decisions. I've run the forecast and they're going to run out of cash in 6 months. And I've shown them that, and they're not changing anything. And I don't know what to do next. They're not wanting to have the conversation despite me showing them the financials. And so I went in, and the issue was dad's got a 50% shareholding, son's got a 50% shareholding. Dad is doing business like he was doing 30 years ago when the business started. Son's doing business like he heard on a podcast. And the analogy I used was it's like Russian roulette. The son's watched 2 rounds of Russian roulette and it's gone, oh, that's how it works. There's no bullets in the gun. Let's go all in. The dad's been dodging bullets for 3 decades. He's much more cautious. Business context is risk profile is showing up differently. Personal context is they've got unsolved stuff from his childhood that is showing up whenever they sit and try and have a strategic business conversation. So they're looking at the cash flow. They can see the numbers. They're smart guys running a good business. They just can't agree on what they need to do. And so the very first thing, even before we got to strategy and cash flow planning and growth plans, was to work out a structure for the two of them to actually communicate. And for me to go into a room once a month and just sit there and be somebody who is not in the family so that they can actually have proper conversations. And that is something that a lot of business owners in partnership, when things get tough, need to be able to do better, is to be able to communicate and get that support. And you'll be able to see when they don't want to do that with you and maybe think, okay, what are some things that we could do differently? And there are huge opportunities here for most accountants in particular, but really any business that has business clients that you're supporting them, to be able to ask more questions, to be able to help them through some of this financial swamp. And by bringing all of that value, to be able to bring more revenue, more value back into your business. That's a huge opportunity right now where there's a skill shortage in the accounting firm. I know most of the people who are with us and watching this are accountants, run accounting, bookkeeping businesses. Huge skill shortage. One way to attract more good people to your team is to offer more of these advisory services. And you don't have to build it all. There's off-the-shelf solutions. There's people you can work with to train your team on simple or even more complex advisory solutions. The difficult thing, which is that investment for the accounting business owner, is when there's a skill shortage, when there's still huge demand for general compliance and general work, then it's difficult to find the time to carve out to try and service clients more often. Better relationships, higher margin clients are there. I know when I was the advisory partner in an accounting firm, when we got the Zero award that Jarvis mentioned in my bio, my clients were routinely the largest revenue, the largest profit margin in the firm, because we were going out there and putting that time in. It's hard to do that for every client, but to look at your business, especially if your clients might be struggling and have a flow-on effect to you over the next 6 to 12 months. How can we do more, deliver more value, bring in more profitable work as a result? And so that is some tips I'd give you to have those conversations, and then look at your business and how you could maybe respond to some of these circumstances as well.
There you go. Okay.
Good. Key takeaways and questions. I might hand it back to you, Jarvis, to summarize. Disagree with me?
No, I'm glad I went first. That was excellent. I think a lot of things that you said there about people dealing with themselves and in their own business relate to the same things they do with suppliers and people they owe money to outside their business. And it's certainly universal that no one likes surprises. Everyone understands difficulty more than you expect that they will, and they want to support your business because you're a customer, and it impacts them as well as, you know, they're humans as well. And it's just about getting that story straight and working out where you're going, and then bringing people on the journey. So, all right, well, to sum up, so clients need help getting out of the swamp. As we saw those stats, 43% of small business owners don't make profit. So I don't know what they're living on, but not a lot.
Well, my accountant makes sure I don't make a profit. So some of that is good tax plan.
Yeah, that's right.
Some of that's one you ran.
Yeah, it's a nice one. So the fast finance is a Band-Aid. It's an expensive one. And often it's a sign that they're starting to make desperate decisions, sort of stress-based decisions. So there's a stat there from some report. When you're stressed, you only have about 13 or 14% of the cognitive capacity of your brain. So, you know, when we say, oh, they're burying their head in the sand, that's why I think, well, actually, they've got all this stuff on their shoulders. They've only got less than a quarter of their processing power to start making the decisions. You see people making bad decisions, and that's where, certainly for me, when I had that first discussion with someone, you know, that's often the most value to them because it shows them there's light at the end of the tunnel, and they just get that relief. I've had people say that it's the first time they had a good night's sleep in like 3 or 9 years, and that's great because that's that personal impact we were talking about. But then it also lets them start thinking about some of these more difficult things there, rather than turning up and just answering the phone all day to go, okay, where am I going to find cash to pay all these people calling me, which naturally isn't going to help you get out of that situation. So the debt reduction that I offer greatly helps, but it doesn't fix the business. And I've certainly got a vested interest there where part of my fees for small business restructures are a percentage of the payments that they make over 2 years. So I've done a lot of SBRs now, fantastic outcome. We'll have a happy fuzzy moment, but there's still 2 years of trading that we've got to get through to pay that off. And it is a lower amount, but that's where what I'm really seeing is there's a need to have these conversations, particularly after COVID, with the cost of living crisis, interest rates, all the things that are on top of people. Very difficult time. And, you know, people need us to have this conversation. They just don't know that they need to have it, or they don't know who to ask. And so I think that's where the opportunity is there for us, seeing their numbers and kind of going, geez, this guy's doing it a bit tough, or his ATO debt's going up, or he's making silly decisions, or look, a prosper loan's turned up, or Moolah, get capital. I won't single anyone out. Those there are indicators that they're doing things they probably haven't spoken to their accountant or bookkeeper about, and they're just not sure what to do. So they're sort of acting reactively. Profitability and cash flow management, that's the way out of the swamp, really. That's how we get to a better, more stable environment where we can start making better decisions. So accountants and bookkeepers, they see it. It's not just the numbers, but it's that relationship there where you're not just handing over the numbers and your invoice, you're actually having that conversation. I guess you don't need to have the full knowledge of profit improvement and turnaround. It's just starting those conversations, which could be as simple as, well, how are you really doing? Are you enjoying running your business? And see where it goes from there. If it's not you, if as the advisor, it's not you that's having those discussions with them, you may be nervous about having the conversation about the fact they're making losses or their ATO debt's getting into the hundreds of thousands, then who's going to have that conversation, I guess? Because if you're scared to have it, the business owners will realize, hey, this isn't working the way I want it to, and they'll go elsewhere, or they'll see something online. Or, for me, it's amazing the number of people that will go onto a website and find me to help them with the biggest business decision of their life, of their sort of business life, some bloke on the internet. So there's opportunity there. And if it's not your bag, if there is concerns about insolvency, or they're complicated, or the business owner feels like they know everything and, they can't be told, well, it might not be a headache that you want to have, but referring them for the assistance if you don't offer the service, or you don't want to, or, the particular client isn't someone you want to have that sort of relationship with, then working with us, we keep you in the loop. You've got the visibility. It minimizes the risk of them going off and finding someone on the internet, finding a new accountant, and the first is the ethical letter, or other silly decisions where you're preparing the accounts and lo and behold, there's the RAM on there, or the something you weren't aware of. So look, that's really it for the presentation. We've got time for some questions now. So usually we have quite a few, but I
had one for you, Jarvis, just touching on that. As you say, you said before, a lot of times it's actually a new accountant that comes to you or refers you the client. And I'm in a similar boat. I'll often go and have a coffee with someone who's interested in getting some coaching or support. And one of the questions they'll have is, should I get a new accountant? I don't think my accountant's helping me, which I then tend to push back on, what are your expectations? And they've never had that conversation with the accountant. When's the opportunity for someone to give you that introduction, or could it be too early, too late to make that introduction to you when someone's got a client who's struggling and they see the need to try and spark that conversation if the client doesn't want to have it with them?
Look, I think most people in my industry will say it's never too early to have a conversation. I guess it's a little bit like if you notice something health-wise, if you go to the doctor early and he says, you're okay, he or she or they say, you're okay, but monitor it, fine. That's the worst case, is that you're okay. But if you ignore it and then you it's in the back of your mind and you come in and you go, okay, now I want to deal with this, that's when it can be too late. And I guess the things that can happen are there's less options there. And I guess probably in the last 2 years where the ATO's issued 30,000 of these director penalty notices, and somehow they're allowed just to issue the letter to the director's personal address, register with ASIC, And it doesn't have to be registered post. It's just to that address. So they could have moved. They might not be getting the mail. Who knows what happened? That's it. If they don't respond to that director penalty notice within 21 days by some sort of insolvency appointment, they're personally liable for the debt. And so the discussions I've been having with people in the last 6 months are regrettably, oh yeah, I got this director penalty notice back in 2022. And it's for $500,000. And so I have to say, well, look, usually I could cut your 500 grand down to 120, but because the director penalty notice expired, you're liable for the full 500 grand, which is not a pleasant conversation to have. So no one wants those sort of bad outcomes. So look, always happy to chat. And if it is, hey, look, nothing to worry about, you'll be fine. Oh, great. I'm happy not to hear from people again. I only charge people if they decide to go ahead with an appointment. So it's always free to talk with someone like me. But they also know that I'm there if they do come back in a year, 2 years and go, oh, actually, you know, here's the update, but now we're ready to get some help.
Yeah, so, I love those conversations. I'm ready now. That conversation we had 8 years ago, I'm now ready. Although, yeah, often in your case, it's because they have been trying some of the other things. There's a question that's popped up, Jarvis, which is more for you than me, so I'll ask you. Can you tell us more about SBR and the chance of success when there's director loans from the company and purely lifestyle director loans, like the RAM you mentioned? So it's not divorce hardship. Directors loan themselves a whole heap of money.
Yeah.
And they go through an SBR because of the tax debt.
That's right. So 90% of companies have director loans, right? Like, I don't know that business owners really realize that they're supposed to be a tax deferral mechanism, not just a tax reduction mechanism. And often that's what triggers a change of accountant is, hey, you know, your director loan's 4 years, 400 grand, and lo and behold, the ATO debt's 400 grand. They come in and talk to me, and I have to say, oh yeah, so that director loan account, you will have to repay that in theory in a liquidation. And that's where discussion comes out about, oh, well, actually, that's in lieu of wages. I didn't know I had to repay it. The accountant might tell me, well, if in doubt, loan account. So it's a difficult cocktail, but we've got 100% success rate with our SBRs for the last 9 months. So it's sort of 30-40. And so that's in the context that probably 90% of them have loan accounts. My team loves it when there's one that doesn't have a loan account. So more straightforward. So the key is, because there are some firms out there that I've heard say, oh no, you can't do an SBR with a loan account because all ours get knocked back. You have to look at the conduct, because that's the ATO sort of says, well, A, you didn't pay the GST or the BAS, and B, you've taken the money tax-free. So they've missed out on the tax 2 times when it's in the company and personally. That said, there's factors at play, which are, sure, there's the conduct aspect, but then there is the commercial aspect, which is, well, if we liquidate, are they actually going to be able to pay that loan account? And the ATO knows that 99% of the time they're going to get zero in a liquidation. Even if the loan account was recovered, it'll often go in legal fees and liquidators fees because litigation is expensive. So I do have a couple of examples where they were borderline and the ATO can tell that this is a bit close. And so what I've seen in those cases is that they probably end up paying 40 to 50 cents in the dollar, but that could still be a great outcome. You could still be writing off up to $500,000 of ATO debt, which is not nothing. So
certainly my experience is that the ATO, HMRC is the same, IRS similar. They don't want to be in the business of shutting down small businesses. 2.5 million small businesses in Australia. They don't want to be in the business of doing it, and they will do whatever they can within their mandate, fairness interests, to help keep small businesses and the people we employ alive and thriving.
That's right. I think, yeah, I mean, they're very keen to make this work. And there's certainly been some where my team and I have been very skeptical about whether it will go through, but the ATO, to their credit, they vote through 90% of them. And overall, and yeah, we've had that 100% success rate. So it's just about getting the balance right. I have that discussion up front with people. I don't promise them 10 cents in the dollar if actually there's $1 million loan account there, or various aspects of the conduct that are probably within their control, and they probably haven't done 100% the right thing, still get a good outcome. So look, one for you, I guess, I'm a sledgehammer. And so talking about profit improvement, cash flow, seems like more of a scalpel approach. And I'm happy to admit it's not my specialty, which is why, I'm fortunate to have you here. But look, I mean, do you need to have an in-depth business knowledge and financial knowledge to be able to advise businesses on improving profit and cash flow?
I think there's certainly an awful lot of business advisors, business coaches out there who got laid off from a bank on Friday and called themselves a business coach on Monday, and are out there giving recommendations and advice that are not sensible and that don't take in the holistic situation. It's why I think more accountants ought to be offering advisory services, because they've got so much of that financial knowledge and skill. They can read the numbers, and the numbers are a key point of truth, but they're not the only point of truth. And I also bump into a lot of business owners who are paying their accountant for advisory or even for business coaching services, where the accountant doesn't have that broad range of skills. They're specialized in the financial advisory, or they're specialized in just having a few questions around some basics: pricing, packaging, sales, anything that you can produce numbers about. Some of the white label advisory services that are out there to train accountants that accounting firms can license are very numbers heavy, and don't go into a whole lot of the other things that keep business owners awake. So brand, marketing, recruitment, culture, vision, purpose, even just the service you want to give the client, expectations that you're setting. When I go through a business, I look at 28 different areas of the business, and I've got tools, toolkits, frameworks, and case studies in all 28 areas. Some are rarer than others, but it's that breadth of expertise, because a business owner is responsible for all 28 areas of their business, and they don't have the time and money to go and get 28 different experts. If you've got specialty in some of the lanes, be clear about that. And I am the generalist, which means I don't have depth across all of those areas, which means I'm then pushing them back to the people who do. Having that perspective, I think, is critical if you're going to start offering strategic advisory services. But that doesn't stop you offering financial advisory services, and it certainly ought not stop an accountant or a bookkeeper from asking a few more of these questions, even if they don't know the answer, the client doesn't know the answer, just to get the client thinking. And a key point that I wrote down that you said, Jarvis, is so many business owners think, if my accountant hasn't raised this as a problem, if my bookkeeper hasn't said that's a problem, it must be okay. Whereas you're screaming on the inside going, why are they not doing anything? They're waiting for you to ask, not to have the answer, just to ask.
So, I mean, as professionals, we often sort of laugh at some of the things our clients do, but it just comes down to that communication, like you emphasized before. So look, I'm just conscious of time, so I might just say a couple of resources on the screen there. We've got an accountant's guide to the small business restructuring process. You can't tell your clients about it if you don't know about it. That said, there's not a lot to know. For me, just trying to make it really simple for people to understand. It's like going in for an operation. You don't want to know what's going to happen on the table, but you just want to know everything, that you'll discuss it all at the beginning, and then go in, have a smooth process, and wake up a success. So really the easiest way I say to people, it's about 24% of the debt is the cost of a small business restructure plus a small upfront payment. So really that's easy to understand. 1% of your debt, if you've got 300 grand, that's 3,000 a month. That's 24 months. Can you afford to pay that? I haven't had someone say no yet. And that's their way out of there. So that doesn't fix profit, but certainly helps cash flow and the debt. And then Jacob, just with your resource there.
Yeah, well, jacobaldridge.com's got a lot of different content, a lot of business videos there around all those different areas as a starting point, and more related to some of the conversations I wanted to share today. We've got a landing page there at jacobaldridge.com/recession. It covers some of the things that I did today in a video. There's a link to a scorecard. And one of the things that I've done with a few different businesses over the years is to be able to white label some of that information for the business owners, the advisors that want to be able to have that conversation but don't necessarily have the toolkit. There's different ways to grab that as well. But re-echo what you said there, Jarvis. Educate yourself and you'll be better placed to have the conversation with your clients before they need it, not after they hit the financial swamp and get stuck.
That's right. Great. Look, Paul has just had a quick question. Is 24% my fee? No.
Nice.
Just to quickly explain, so 20% is what we aim to reduce the debt to. So 80% of the debt is written off. And then the law requires me to charge a percentage of the amount they're paying creditors. So 20% of the 20%. So that's 4% of the total debt. So what I'm saying there is 24% is all in your ATO debt, your fees. So if you got the 300 grand, 3 grand a month covers the fees, the ATO payments, everything. So try to make it simple. There's no hidden fees. It's all clear. It is a great outcome. So being able to tell someone that their $1 million ATO debt is now 250, 300 grand, or even for someone with 100 grand to say, hey, you only need to pay sort of 24, 25 grand, like it's wonderful for everyone. It's amazing the ATO is supporting it. And it's real contrast there, because if you're not doing that, you're just avoiding the ATO. They know and they'll come after you. On the other hand, you're in there and they're supporting, 90% plus. Like I said, in my case, for the last 9 months, 100% success across 30, 40 that we've done. So fantastic, great to be able to offer it. And, your client is going to love you if you get them that result. So it's a good, clean slate. And that's where I think it's a good opportunity to say, well, look, you're getting this debt reduction, but what are we going to do to fix your business so you don't come back here? You don't want to, you want to bottom out when you restructure and then go back up. You don't want to bottom out and then keep digging the hole because you can't restructure again. So, all right, look, fantastic. I'll wrap it up there. Let everyone go on with their days. Jacob, thank you very much. Fantastic having you with us today.
Pleasure to be involved, and enjoy the rest of your day, everybody.
Cheers. Okay. Thanks, everyone.